they are behind the curve. They're not ahead of the curve. He was implying they look at the daily data. They're on top of things. They're, bobbing and weaving. They know exactly what's going on. This is just baloney. They've contracted the monetary supply, and as a result, I think later this year, or maybe as late as the early part of next year, we'll enter a recession in the United States. What I keep saying, the Fed's flying blind. The big problem is he's only talking about interest rates. Interest rates, that's what everybody talks about, interest rates. The
Right.
Fed funds, it's a big deal, big story today. But interest rates say very little about monetary policy. You'll know they've hit the panic button when they stop quantitative tightening.
Fed Powell was asked about the recession specifically, and he is still pushing that we could still hit the soft landing narrative. But remind us that this is the same guy that told us inflation was transitory. But, what do you make of that? Why does he not see it? Why are they not looking at the same data that you are?
On the Spot with Michelle Makori is brought to you by Goldback Inflation-resistant 24-karat gold currency.
Hello, I'm Michelle Makori. Thank you again for joining us. The Federal Reserve has cut interest rates by 0.5 point for the first time in 4 years.
In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting.
Fed Chair Jerome Powell also said that the economy is strong overall and that the Fed has growing confidence that the strength in the labor market can be maintained. Well, my next guest says that the Fed is flying blind and looking at the economy all wrong, and that the rate cuts are not where the focus should be. Here to give us his analysis and perspective is Professor Steve Hanke. Steve Hanke is a professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University. He's also a special counselor to the Center for Financial Stability in New York and a well-known currency and commodity trader. In the past, Professor Hanke served on President Reagan's Council of Economic Advisors and has been a senior advisor to the Joint Economic Committee of the U.S. Congress. He's also the author of several books, including his latest, Capital Interest and Weighting, Controversies, Puzzles, and New Additions to Capital Theory. Professor Hanke, good to have you with us. It's been too long. Welcome back.
Yes, great to be with you, Michelle.
All right, Professor, let's get into it. We had the first rate cut in 4 years since March of 2020, and by 50 basis points, which was perhaps more than what was expected. I know that you were calling for 50 basis points. I take it you weren't that surprised by that. But when Powell was asked what message this sends to the American people, here's what he had to say.
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
So, Professor Hanke, what do you make of the move?
Well, it was anticipated by the markets, Michelle. The federal funds futures markets closed last night on the Chicago Mercantile Exchange, indicating there was about a 65% chance that they'd have a 50 basis point cut and a 35% chance that they'd have a 25%. So, and that had swung around from the 25 to 50 over the last 3 or 4 days. So that was pretty much priced into the market, and it happened as the market anticipated. And if you look at the market reaction, not much happened in the market. That's what I said was going to happen. I thought if they only did 25, since 50 was priced into the market would have sold off big time. But actually, the market really didn't do much of anything. The dollar didn't move much. It was just kind of quiet. Everyone really anticipated 50, and that's what they did. Now, the question is, Powell, listening to Powell, of course, his narrative is one in which he should have been wearing a halo while he delivered that remark in what I call the Fed spin room, because he's spinning the story, spinning a narrative, and the narrative is we're doing everything right and we're going to have a soft landing. The economy is going to remain pretty strong. Inflation is going to come down even lower than the 2.5% that it is right now, come down to 2%, the target. And everything's going to just be wonderful. The big problem is he's only talking about interest rates. Interest rates, that's what everybody talks about, interest rates. The right. Fed funds rate. It's a big deal, big story today. But interest rates say very little about monetary policy. Monetary policy is gauged by looking at what's happening to changes in the money supply, and precisely what's happened to changes in the money supply a long time ago. That's what affects what's going on in the market today. And if you look at what's happened in the United States since July of 2022, the stock of money in the United States has actually shrunk. And that's only happened 4 times in the United States since the Fed founding in 1913. 1913, the Fed was founded. And since then, there have only been 4 of these monetary contractions, and all of them led to recessions, including, of course, one big Great Depression. The contraction in 1929, 1933 in the money supply, we had the Great Depression. So that's why I think they are behind the curve. They're not ahead of the curve. He was implying they look at the daily data. They're on top of things. They're, bobbing and weaving. They know exactly what's going on. This is just baloney. They've contracted the monetary supply, and as a result, I think later this year, or maybe as late as the early part of next year, we'll enter a recession in the United States. And by the way, the inflation rate will keep coming down. It's at 2.5% now. John Greenwood and I predicted, using the quantity theory of money, that it would end the year between 2.5 and 3%. So I think we're going to be pretty close. And I think next year it'll continue going down, probably go below 2%.
All right, a lot to unpack there, Professor. But let's start off with this inflation that you mentioned, because when you were on the show, you correctly called that inflation would peak at, around 9%. You were correct. It peaked at around 9.1% in June of 2022. The current rate of 2.5% is still below the Fed's 2% target. But you've long said that inflation is always and everywhere a monetary phenomenon. So given that, and given what you're saying about the money supply, explain how you see inflation then playing out.
Okay, let's first go back to, the last time we were together, I think was in 2022.
No, that was the last time when you made that call for inflation at 9%, that was before that with my then colleague, David Lynn, when you were saying inflation was going to hit that.
Right.
I've only had the pleasure of interviewing you once before last year, but you did make that call correctly when you were on Kitco News previously.
It was a Kitco call.
Correct.
So let's go back to that to understand what's going on. So we had COVID start in February of 2020. Then the printing press started running at a very high speed in the United States. The Fed let the money supply get out of control, and grow at an unprecedented rate when it peaked out at 27% year over year in February of 2021, a year after COVID broke out. They hit the peak. And then what happened? We had July of 2022 when the inflation rate peaked out at 9.1% in the United States. So the picture was the first thing, you goose the money supply, and then with a lag, inflation follows, and that gets goosed, that peaks out. Then they put everything in reverse, and the money supply starts going down, down, down. And as I said, the money supply is actually lower today than it was in July back in 2022. So given that, we know with a lag, inflation was going to get wrung out of the system. And that's what's happening. So money supply goes up and inflation goes up. Money supply comes down, inflation comes down. So this is the monetarist view of things. It's the monetarist quantity theory of money model, and it's a monetarist narrative. But that's not the narrative you're hearing from Powell, because the Fed rejects monetarism completely. The Fed says there's no connection between changes in the money supply and changes in economic activity and changes in inflation. And that's what most of the big central bankers, you're up there, actually you're in New York, but Kitco's in Canada, and the Canadian governor echoes exactly what Powell says. The Bank of England has been saying the same thing. The European Central Bank, the same thing. They reject what I just said, that there's a link between the money supply and economic activity and inflation. But they're wrong. They never predicted, by the way, where inflation's going. I mean, right now, Powell is holding a trophy in his hand for being a genius for wringing inflation out of the system without giving us a recession. But the reality is the reason is because the money supply has been contracting, and it's growing at a very slow rate now, Michelle. The money supply in the United States year over year is growing at 1.26% per year. And Hanke's golden growth rate, a rate consistent with hitting the Fed's inflation target of 6%, of 2%, is a growth rate in the money supply of about 6%. Golden growth rate, 6%. That's where the money supply should be growing if you want to hit the inflation target at 2%.
So, Professor, help us understand then what impacts the money supply. What policies lead the money supply to either expand or contract?
Well, a couple of things. One is what's going on with the size of the Fed's balance sheet. If the Fed's balance sheet is expanding, they're buying government bonds. And when they buy government bonds, they issue credit to the government to pay for it. And that credit to the government, it's part of the money supply. The money supply grows. The other aspect right now is that they're in quantitative tightening. They're shrinking the money supply because they're shrinking the balance sheet of the Fed. They're not buying bonds. They're letting bonds mature, and that is causing the money supply to decrease because the government still has to sell the bonds to somebody. They sell the bonds to the non-bank public. And when they sell the bonds to you, Michelle, or me, we have to write a check. We write the check and we get the bond. But what does that do? That reduces our checking account, and the checking accounts are part of the money supply. So that shrinks the money supply. So that's part of the picture. The other part of the picture is the commercial banks and whether the commercial banks are loaning at a high rate or a low rate, because commercial banks create most of the money. Most of the fiat money actually created is by commercial banks. And right now, the loan growth is only about 3% year over year. in the United States. So the commercial banks they're loaning, but at a pretty slow rate.
And what impacts the bank's rate of loaning? I mean, doesn't the Fed rate have an impact on that?
Well, indirectly, it slowly will incentivize the loan market to be making more loans. So in that sense, indirectly, these Fed funds rate reductions do work themselves into the structure of interest rates, because mortgage rates come down, credit card rates come down, loans at the bank eventually come down. So it does have an indirect effect, but it's a second order effect. The first order effect is what is happening to the balance sheet of the Fed.
And that is a point you've made before, that we should be focusing on the balance sheet. And at the press conference, Powell said that you can have the balance sheet shrinking while cutting rates, saying that they'll continue reducing holdings of Treasury securities and agency debt and agency mortgage-backed securities. His direct quote, "What that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side in a sense. They're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also cutting rates." So what's your take on that?
Yeah, well, they're contradictory. The big elephant in the room is shrinking the balance sheet and leaving quantitative tightening on, and that will overwhelm the 50 basis point reduction in the federal funds rate. So that means that although the rate of growth in the money supply is creeping up a little bit, I said 1.26% year over year, it's not going to change all that much as long as they have quantitative tightening in place. And he said they were going to keep quantitative tightening. But all this means, by the way, is that the Fed doesn't understand what it's doing, and it's not watching the money supply. Its narrative is not my narrative at all. Its model is not my model at all. Mine is a monetarist model, a quantity theory of money.
So why is it that all of these central banks focus on the rate hike or cut and not as much on the money supply?
Because the quantity theory of money, although it's been the traditional model that's in all macroeconomics until about 30 years ago. About 30 years ago, macroeconomic models started changing and kind of drifting into what I call various forms of post-Keynesian models, not monetary models. And so all the young people working at the research department at these central banks, they were trained with post-Keynesian models. Those models don't even include aggregate measures of the money supply. Now, how can you be running a central bank and are having a macroeconomic model that doesn't even include money? That's the one thing that central banks produce. I mean, it's kind of bizarre. I mean, quite frankly, it's stupid, but I'll use the word bizarre and be polite.
Okay. So you're saying that the focus should not be so much on the rate cuts, but more on the quantitative tightening, which we're understanding is continuing, and that therefore that will actually help keep inflation under control, if I'm understanding that correctly.
Yeah, right. But it'll also, quantitative tightening is keeping the money supply growth rate so slow that we'll have a recession. So that we'll definitely have the lowering of continued fall in the inflation rates, which is very important for the markets in a way, because remember that bond yields follow inflation. Wherever inflation goes, bond yields follow that. And what's happened? The money supply is contracted, step one. Inflation falls, step two. Bond yields go lower, step three. Bond prices go up, step 4. And I started the most important bond in a way in the United States is the benchmark 10-year bond. And I started recommending that peaked out at around 5%, the yield. And at about 4.8%, I started recommending to buy the 10-year because I thought the money supply was contracting, inflation would continue to fall, and yields would fall, and bond prices, the 10-year would go up, and you'd have a nice capital gain. You'd be getting a pretty good yield, and you'd also have a big capital gain. Now, we've gone from when I started recommending buying the 10-year, it was 4.8%. Now it's a little over 3.6%. So you've had a huge reduction in yield and a huge increase in the price of the 10-year. It's been a great trade. Very safe. By the way, very safe trade.
Well, Professor, last we spoke, though, which was about a year ago when you and I spoke, you were expecting a recession by the first half of 2024, largely based on the contraction of the M2 money supply. We didn't get a recession according to the technical definition of a recession being 2 quarters of negative GDP growth. In fact, official government data, depending on how much you trust that, would tell us otherwise, that the U.S. economy grew at a faster pace than originally estimated in the second quarter, at an annualized rate of 3% in the second quarter, revised upwards from 2.8%, and the first quarter grew at 1.4%. But technically, not a recession according to the technical definition of 2 quarters of negative GDP growth. So what do you make of that?
Okay, now this is an important point. I think around the time, probably shortly after you and I spoke last, Michelle, John Greenwood and I, and looking at what was going on and the link between changes in the money supply and changes in the economy, it was clear to us that this was taking. There are long and variable lags between changes in the money supply and changes in economic activity. That's the big point. And we were on when we said we thought we'd get a recession sometime late 2000 or early 2024, early this year. We revised that shortly after to say late this year or maybe early next year. So the lag is variable and it's long, and that's why it hasn't arrived. It hasn't arrived yet. It will arrive, by the way. That's for sure. It will arrive, but it's just not going to arrive. It has not arrived as fast as John and I originally thought it would. And that's why I say when we talked last time, shortly after that, we actually changed and lengthened the lag between the changes in the money supply and when we thought the recession would occur. So it's very hard to hit the target exactly.
But you're still seeing a recession by the technical definition of 2 quarters of negative GDP growth hitting by the second half of this year. I know a lot of people feel like there's a recession already and that there's a disconnect between the data.
It depends on how you define it. They define it in various ways. Even the National Bureau of Economic Research is really the gold standard for defining U.S. recessions. They include many other things besides the 2-quarter thing. But just taking that definition, I think we will see that starting late this year or early next year.
So no soft landing.
And by the way, in a way, is that really that important? The main thing, it's like trading. You got to get the direction of things right.
Right.
And the direction is the economy slowing down.
Well, Fed Powell was asked about the recession specifically, and he is still pushing that we could still hit the soft landing narrative. If we have that soundbite in the recession, I'd like to play that for you and get your thoughts on that.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't, there's, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that, no.
All right, he doesn't really see that. I'll remind us that this is the same guy that told us inflation was transitory. But, what do you make of that? Why does he not see it? Why are they not looking at the same data that you are?
He doesn't see it, Michelle, because the Fed is not looking at the money supply. So if you're not looking at it, how can you see it? He's flying. He's what I keep saying. The Fed's flying blind.
But respectfully, I get that you said that this is a different, school of economic policy, but surely when you have all of this collective education and brain power at the Fed, I mean, surely someone should be saying, hey, let's look at the money supply as well. Why do you think that as an indicator is so entirely dismissed?
I think for the reason that I gave you early, all the theoretical models and the training of the graduate students that are in the research department,
but Powell's not that young.
They're trained with models that don't include the money supply. They're called post-Keynesian models. That's one aspect. The other aspect is ideological, and that is most of the employees in the research department, they're over 700 economists that work in the research department at the Fed, a huge staff in the Fed, in the whole system of all the Federal Reserve banks, including headquarters in Washington. So and the vast majority of these are Democrats. The vast majority of those are Democrats. Now, why is that relevant? They're not Republicans; they're Democrats. And the key there is that the dean of monetary economics happens to be Nobel laureate Milton Friedman, who of course everybody knows of, and he was a big time Republican. And he influenced the Republican presidents enormously, including the president that I worked for, Ronald Reagan. So Milton Friedman is kind of the guru of monetarist and monetary theory and the classical monetary quantity theory of money. And so he's kind of ideologically, he's kind of the enemy. He represents the enemy. And he represents the enemy of Democrats. Well, if all the research department, almost all of them are Democrats. So you get the picture?
So it's again this sort of major ideological division that we're seeing in the country at large, I think, on many issues.
I think it does come into play. It's a little bit more subtle, by the way, than the kind of primitive divisions that you see in the public today. The one I'm talking about is actually quite a bit more subtle and sophisticated, but it's still it's a division, and it is real, by the way.
I'm sure it is. I mean, we've also, we've got the likes of people that push for MMT, which is a very, you could say, left-wing idea that you can just continue to print money. Modern monetary theory.
Modern monetary theory, of course, completely rejects the quantity theory of money and what I'm talking about right now. That's kind of an extreme form, but in a way, it's an interesting one because it's very transparent. Once you get into the post-Keynesian models, you're getting out into the technical weeds. And it's hard for people who aren't really trained formally in economics to even know what you're talking about. But modern monetary theory is a little more easy to grasp for the average Joe or Jane.
And as you say, is in stark contrast to your economic policies that you espouse.
Right. Don't get the thing too personal with me, because modern the quantity theory of money has been around and used by virtually everybody since the 15th century. So it's been around a lot, 15th, 16th century, and then even Keynes himself, by the way. If you look at Keynes's 2-volume treatise, that's all quantity theory of money. Keynes, before the general theory, that's what Keynes was writing about. So I think Keynes is in my own view. I think the most interesting book Keynes ever wrote was the treatise. And that's a 2-volume job, heavy duty, and it focuses on money and the quantity theory of money and banks.
Right. I'm going to have to catch up on that book then. I have some travel. It'll be a perfect time to read that book, Professor.
Now, Michelle, Keynes is a wonderful writer. He's a master of rhetoric in the English language, but it is the kind of thing you wouldn't want to be reading that thing before you did much driving.
In case I doze off, I've got you. That's why I said it's good reading for a plane ride. Professor, okay, so given we have a Fed that is dismissing the economic, school of thoughts and policies that you and others well before you have been following, they did cut rates by 50 basis points, and they're not really budging on quantitative tightening. What do you think that means in terms of you're seeing a recession hitting in the second half, you're seeing inflation start to come down? What does this mean for the labor market? Give me a broader outlook of how you see their mistakes impacting. A broader outlook
of what I think will happen. The scenario will be this. The Fed is data dependent. And Powell makes that very clear, by the way. And in the spin room today, he told the reporters, they said, what's going to happen? He says, we'll watch the data. We'll watch the data. We'll keep on top of the data. So they're watching the data, watch. And pretty soon they'll start getting a lot of bad data as we enter the recession, and the labor market will start looking pretty bad. And the Fed will make a big pivot then. They'll lower the Fed funds rate even more, and they'll stop quantitative tightening. That's when they'll stop quantitative tightening. So they will pivot, but it'll all be way too late, because the contraction in the money supply that's going to give us eventually a recession, that all happened back in 2000. It started happening in 2022, a long time ago, about a year and a half ago.
So you're saying that the real pivot should be related to quantitative tightening, pivoting to quantitative easing.
You'll know they've hit the panic button when they stop quantitative tightening. That might happen even after the next reduction in the Fed funds rate, because they will keep reducing the Fed funds rate because I think the economy will continue to slow. It'll continue to show weakness. Like, remember, we had that huge revision in the labor market, where all of a sudden 800,000 jobs were that they told us we had. They said they revised the labor market report, and they said, well, those really didn't exist. So they revised things down tremendously already. He never talked about that, by the way.
I did notice that was glossed over, and it's a point that I was making as well, that, you have a Fed that's so data dependent, but then you have data that's so unreliable and revised by a dramatic 818,000 jobs per that last labor jobs report. So, how do you see, so they're getting data that's inaccurate, that's being revised to the downside. How do you see the labor market then being impacted? You see that continuing to decline? In principle, being data dependent is a bad thing,
and won't guide you because you're not paying attention to changes in the money supply. And you're giving a good illustration of just why it's a bad thing. You're always looking in the rearview mirror with data dependency, because the data that are being generated today are all being caused by changes in the money supply that happened a year ago, year and a half, 2 years ago.
So what do you expect then in terms of the housing market?
Well, the housing market is kind of interesting because, number one, there's a huge backlog. So the housing stocks, builders, I've been bullish on them for a long time because there's such a backlog of housing. If you look at the mortgage rates, they're coming down. And remember, I said yields follow changes in inflation, and changes in inflation follow changes in the money supply. So the money supply change negative, inflation falling, yields falling across the yield curve and in the mortgage market. And we're starting to see an uptick in refinancing in the mortgage market. People are coming in now. It's getting a little bit more active. So I think there'll be strength in the housing market. There'll be certainly more turnover in the housing market.
Does that mean
because mortgage rates are going to come down?
So does that mean then higher prices for housing?
Oh, yes.
Well, you mentioned that the real pivot is when quantitative tightening becomes quantitative easing. But where are you in terms of your thoughts on a rate cutting cycle? You said that they're going to get more data, continue to cut.
They're going to keep cutting because the economy is going to keep slowing. And you'll keep getting more of these big revisions that the labor market really wasn't as strong as everybody thought it was, and negative weakness. And the more of that the data dependent Fed sees in front of them, they will be inclined to lower the Fed funds rate. And that the Fed funds rate seems to be an obsession with them and with the journalists and with the markets and with everybody else, because the narrative that's followed is all generated in the spin room. You saw it today. You're paying clips, and the journalists eat it up because the journalists always want access to the Fed, and the only way they can get access is if they echo what the Fed tells them. If they're contrarians and they're not echoing it, they're going to get cut off.
But you don't get invited. That's right. You don't get invited to the spin room to ask
they're not going to be in the spin room.
Okay, so given this picture, help us understand what you expect then, for the markets, and we'll start off with equity markets before we shift to commodity markets, when this reality starts to kick in.
Well, I think the equity markets are very pricey right now. At a very high level by any historical measures and standards. There are various metrics you can measure the valuation, and any of them, they all tell you, no matter what the model is, they tell you the market's pretty pricey right now. So what happens when a recession hits? The top line revenues to companies go down, and their margins starts getting squeezed, and their earnings start getting squeezed, and ultimately the PEs come down in the market. So I think the market's pretty vulnerable right now, and I don't think the market's pricing in the risk of war. We have two hot wars going on in Ukraine and Gaza right now. I don't think those are priced in at all. So that's another risk factor that's not in the cards. And I also think China is a big risk because the golden growth rate that's consistent with hitting the inflation target in China, Hanke's golden growth rate is what? 11% per year for M2. The M2 growth rate is 6.3% in China. China's money supply is growing very slowly. To hit that inflation target they have is 3%. It's not 2%. Their target's 3. The golden growth rate's 11. They're growing at 6.3. Inflation is 0.6%, about 0.5%. There's no inflation in China. So the economy's slumping in China. And what does that mean? China, depending on how you measure it, it's either the first or the second biggest economy in the world, China, and it's very commodity oriented. So the commodity markets, why do you think the oil market's so weak? Why do you think the oil's trading around $70 a barrel? Why do you think oil has come off $11 a barrel in the last 3 months, $5.50 a barrel in the last month? It's because of China.
So you have
China in commodity markets, China is the tail that wags the dog. And you, to understand China, which no one talks about correctly if you read the press, the only thing that counts is what's going on with the money supply. How is the money supply growing relative to the golden growth rate of 11% that's consistent with hitting the inflation target of 3%? And it's growing at about half the rate it should be growing at. Way too slow.
So you're concerned about China's economy impacting commodity demand, but would that include gold? Because we saw gold hitting a new record high after the Fed announcing that it was cutting by 50 basis points. We've seen
yes,
gold on a tear.
That's a very interesting point.
And China, as we know, China's central bank has been buying record amounts of gold from at least what they're reporting.
So China is part of the bullish story on gold. And one reason that I'm bullish on it, because not only the central bank has been buying big time in China, but private investors have been buying big time because they're worried about what's going on in China. There's a huge private demand for gold in China. And in a way, in China, the private buying is a little bit the tail that's wagging the Chinese dog.
You mean individuals, private businesses?
Yeah, individuals, private individuals. So you've got publicly the central bank, we know they're buying big time. But one thing people haven't been paying attention to is the private buying and private speculation in China and gold. And it's been very significant. And that's part of the bull run in gold that's been generated. Over the last 3 months, gold, it was it hit a new high of 2,600 and change. I think 27 and 20 was the high today, and part of that has been Chinese private, part has been public. But the last 3 months, gold has been up, over about $275 an ounce. The last month it's been up about $60. That's a lot of that's coming from China.
And you're saying that's because individual investors in China are seeing a slowdown in the Chinese economy.
Yeah, they're getting worried. They're seeing, for example, the real estate crash and problems they had in the real estate sector. The press is always writing about that, and the fact that prices of real estate, they're actually going down in China. Well, that scares the pants off of the Chinese. And what do? If you get your pants scared off, you buy gold.
So you've got that driving the gold price. I want to bring it back to what you said about markets not pricing in geopolitical risk, equity markets. Do you think that is being priced into gold because gold is supposed to be a safe haven in terms of geopolitical volatility?
To some extent, but I don't think war is being priced into the markets in general, including gold. I think there's a significant chance for very big escalation in the Middle East. It's happening right now with the attacks on Hezbollah the last 2 days. The Israelis are escalating things, making it much more dangerous in the Middle East. The Israelis are, creating an escalation. An escalation is what? It's dangerous. It should be priced into the market. I don't think it is priced into the market.
Do you think that election in the U.S. is another potential factor that should be impacting the gold price? And depending how that turns out. We had billionaire investor Paulson, for example, saying that, if there's a Harris win, he's going straight into cash and gold. So what are your thoughts there?
Well, my thoughts are he's a good friend of Donald Trump's. and he's a bit, and also he's known as a gold trader. So
what are your thoughts on how the election is being factored into the price of gold or not factored into the price of gold?
I don't think it's playing much of a role.
Do you think it should?
It's not the kind of thing we were talking about with China. Believe me, there's not much. There's not an excessive amount or not much private buying in the United States of gold. By the way,
right. But in terms of the safe haven geopolitical risk and that potentially being impacted by the U.S. election outcome, you're saying that all of that is still not even remotely factored.
I think that's still around the corner. Something that's the general public and market participants haven't realized how dangerous things are particularly in the Middle East. Also, obviously, if the West and NATO decides to escalate by following the recommendations of the United Kingdom, that is to facilitate the firing of longer range missiles by Ukraine into Russian territory, I think that's just a game changer. Putin has said very clearly, by the way, that it's a game changer. And I think that's one reason why Biden hasn't caved in yet to demands by the United Kingdom. The United Kingdom really are the warmongers, and all that started with Boris Johnson when he was the Tory prime minister. He's a little bit of a madman, and he's still in the game. He's still trying to promote this. He was just in Kiev, and now you've got the new Labor government coming in, and the Labor prime minister seems to be just as mad as Boris Johnson.
I mean, why would they want to escalate this conflict? I know that, I understand that Putin has said that long-range missiles supplied by a NATO member to Ukraine is the equivalent of a NATO attack on him.
I think the West is panicked right now because Russia is taking Ukraine to the cleaners on the battlefield, and they don't want to get into a situation where things end and they come up with some peace agreement right now, because it's very clear that Russia would keep the 4 territories that it's taken over newly, and they would retain Crimea. I think that's really what's going on with the calculus.
So broadly speaking,
Ukraine, what's going on in Ukraine that we don't get in the Western press, but the reality on the ground is that the Russians are cleaning the clock of the Ukrainians. The Ukrainian army is dissipated completely. They don't have any men. I mean, they've killed 600,000 in this war. It's eaten up 600,000 lives, if you can imagine. What a tragedy, and destroyed Ukraine, a lot of Ukraine.
Well, Professor,
it's completely mad.
Professor, the narrative by the West, if you will, on the Ukraine-Russia front is that Russia's army isn't what people thought it was, and that's why this war is taking so long, right? That if Russia was as strong as we believed it would be, this Ukraine conflict would have been over so quickly. and that Ukraine is winning by virtue of the fact that, it didn't succumb to Russia within the first couple of months. So
that's a completely delusional statement. The Russian meat grinder is working at high speed and absolutely grinding up Ukraine. Anyone who's well informed knows very well what's going on. Eastern Ukraine is being taken over, meter by meter by the Russians right now. They're on the move, and the move that the Ukrainians made with the West agreement to go into Russia, it was absolutely an insane political tactical move, because all those troops that were the Ukrainians sent in there, they'll none of them will ever see the light of day in Ukraine again. They'll all go back in coffins.
Yeah. Look, many would say that this entire conflict was a completely unnecessary escalation, with green-lighting Ukraine's membership into NATO, or at least accelerating that process, that was just an unnecessary provocation in the first place.
There's no question about it. There's no question about it.
But, either way, war is tragic on all fronts. And you're saying that you think that this market, be it equities, be it gold, no one is pricing in the risk of major geopolitical escalations.
Right.
When you say substantial risk of escalation, give that to me in odds. Like, do you think, what do you think, and what happens? Let's go with Russia, Ukraine first before we get to Middle East. Do you think, what could Putin do?
Well, the exact magnitude, again, getting the direction right is in trading what's important. Exactly the magnitude, where things are going to go, and what the risks are that should be weighted and so forth. I think that's the second order factor. The first order is the direction, and the direction clearly in the Gaza thing is escalation. Israel wants to escalate this thing, and ultimately, if truth be known, they want to drag the U.S. into the whole thing. That's really, and that's exactly the calculation the Ukrainians are making. They'd love to drag the U.S. into the thing. That's what the British seem to want to do too. The paymaster in all of these things, and who's financing at the margin, what's the key financer? It's the U.S. The U.S. is financing both of them at the margin. If the U.S. stopped financing, the whole thing would wind down in a hurry, in both places.
Well, I think we would have many geopolitical experts that would give you a different take on that one. But let's focus on, back to the market.
The question is who's right or wrong, and I'm pretty certain from a financial point of view, I'm right. If you're not financing a military operation, the military operation stops.
Well, it depends. On the Russia-Ukraine side, it's one thing, but on the Israel-Gaza side, you still have the other side being financed. And, maybe you could even say that that's also financed by this current administration, because they've been financing Iran, which has been able to finance its terrorist proxies. So maybe on one level, you could even say that the U.S. has been financing both sides of the Middle East conflict.
I'm talking about direct taxpayer finance.
Well, yeah, in terms of weaponizing one side and weaponizing another side. But let's bring it back to the markets, Professor. What does this mean in terms of your gold price target? Then, I know you don't really love to give targets, but I know you're a direction guy. So basically, you're seeing the direction continue.
I'm a direction guy, and it's going up. It's going up. The bull is still raging.
The bull is still raging on gold.
The bull is still raging, and if all these risks that aren't factored fully into the market that I think exist, if those actually show up on the radar screen of investors, that's just going to fuel a gold bull market even more.
Right. a gold bull market is raging. You're seeing the US hit a recession, and you're seeing when does that start to hit the US equity markets in terms of a timeline?
Hard to tell in terms of timing, but we again, the direction you can pretty much anticipate. And I think people like Warren Buffett, if you look at Buffett's portfolio, he's gotten so heavy in cash at Berkshire. Well, why has he done that? If you listen to him very carefully, it's very clear he agrees with me. He thinks the market's very pricey, and that there'll probably be an adjustment, and the PEs will come down, and the market will come down. The market in general. I'm not talking about specific stocks, but the market.
Right. So, Professor, let's bring it back to the Fed. As you said, you think that all this focus on interest rate cuts is misplaced and that it should be more about the money supply. Given the economy is in the state that it is in right now, what would you advise the Fed? What would you be saying that they should be doing?
I wouldn't say that I say the interest rates have been misplaced. I would say that the interest rates are not a good indicator of the tenor of monetary policy. To find the tenor of monetary policy, you have to look at changes in the money supply, not changes in the interest rate. I would have cut the Fed funds rates a long time ago. I said they were behind the curve. In that sense, they got the timing wrong. They should have stopped quantitative tightening a long time ago, and they should have reduced interest rates a long time ago. That's what I'm saying. And that would have mitigated the collapse and contraction we've seen in the money supply.
And that wouldn't have increased inflation then?
No, it wouldn't have increased inflation.
If you have more money supply?
The inflation rate might have not gone down quite as rapidly as it has gone down, but it would have gone down because the money supply, remember, the golden growth rate is 6%. As long as you're at 6 or below, you're going to be zeroing in on that 2% target or even maybe below 2% target.
Okay, so conclusion here as we wrap up, Professor Hanke, just give us your final thoughts on your macro outlook for the U.S.
Macro outlook, keep your eye on the money supply. Whatever is changing in the money supply will show up with a lag of a year and a half in economic activity and inflation. Change the way you think about things. Stop thinking about interest rates and start thinking about the money supply. That's my message.
Okay, we got that message.
Stop flying blind. Stop doing what the Fed is doing and being data dependent. Start looking at the money supply.
All right. Well, you've made us absorb that message loud and clear. I look forward to checking in with you again. Professor, thank you so much, Professor Steve Hanke. Appreciate your time today.
Be great to see you again, Michelle. Thank you.
Thanks again, Professor Hanke. Thanks to our viewers, and a big thanks to our sponsor, Goldback. For our viewers not yet familiar with this easily portable form of gold, Goldbacks are physical, interchangeable gold currency made of real 24-karat gold. These are gold notes with real gold woven inside, and the gold is vacuum deposited using state-of-the-art proprietary technology. And with Goldbacks, you can help protect your wealth against fiat currency debasement and devaluation through the stability of gold, because they're made with real 24-karat gold, and hence they appreciate along with the price of gold. And Goldbacks also allow you to own and spend gold in small interchangeable increments. In fact, you can buy Goldbacks starting at just about $5. Goldbacks can also be used as real money from small to large transactions. There are over 5 states where Goldbacks can be used to pay for goods and services, and there are over the growing list of 2,000 businesses where Goldbacks are accepted as payment for goods from coffee to sneakers to RVs to services like chartering flights, getting your car repaired, and even paying for your accounting services. All of these providers accept Goldbacks in those states. And there's also a way to earn interest on the Goldbacks that you own, paid back in Goldbacks. You can get all of those details on goldback.com. So if you want to diversify your gold holdings and get some goldbacks, there is a link in the description of this video with where and how you can buy your goldbacks. So please check that out. As usual, thanks for checking us out. For me, Michelle Makori, and the rest of the team, we'll see you next time.
On the Spot with Michelle Makori is brought to you by Goldback, inflation-resistant 24-karat gold currency. Protect your purchasing power, grow your wealth annually, and spend at over 2,000 businesses. Learn where to get goldbacks at goldback.com.